By 2026, more U.S. Treasuries may settle on blockchains than on some regional bank balance sheets. Let that sink in. Crypto was supposed to replace banks. Instead, it's becoming the rails for Wall Street. In 2022, tokenized real-world assets were barely a rounding error. By 2025, tokenized assets surpassed $24 billion, growing over 200% year-over-year. And major institutional forecasts now project tokenized assets could approach $400 billion by the end of 2026 if adoption continues at the current pace. This doesn't mean coins. This isn't JPEG speculation. This is treasuries, private credit, money market funds, infrastructure debt. Crypto didn't die. It evolved. And most retail investors are still arguing about altcoin cycles. The problem/opportunity. Let's zoom out to 2026. Fed rates stabilizing near 4.5%. Infrastructure spending at multi-trillion-dollar levels. Sovereign debt at historic highs. Liquidity tighter than the 2020 stimulus era. Capital is expensive again. When money costs something, efficiency matters. Tokenization solves one problem traditional finance has never fixed: friction. Settlement delays, minimum investment thresholds, geographic limitations, opaque private markets, tokenized real-world assets. RWA aim to digitize and fractionalize assets like U.S. Treasuries, corporate bonds, private credit, real estate, infrastructure projects, and allow them to trade 24/7 on blockchain rails. Think of it like converting paper deeds into programmable code. Same asset, different plumbing. The wealth gap dynamic. Here's the uncomfortable part. The top 1% aren't buying random tokens. They're allocating to private credit, infrastructure debt, yield-bearing short-duration assets, structured products. Retail investors, still stuck in 2020, meme coins, a leverage, next 100x narratives. Institutions are not chasing volatility. They're chasing yield with infrastructure efficiency. And that's the pivot. Pillar 1, tokenized U.S. Treasuries, the gateway asset. Let's start simple. Tokenized treasuries are exactly what they sound like. Short-term U.S. government debt wrapped in blockchain infrastructure. One major example, BlackRock USD Institutional Digital Liquidity Fund. This fund tokenizes exposure to U.S. Treasuries and cash equivalents. Why does this matter? Because treasuries are the global risk-free benchmark, highly liquid, yielding 4-5% in a higher rate regime. Now combine that with 24/7 settlement, fractional ownership, instant collateralization in DeFi markets. That's structural innovation. Advanced metrics. Why treasuries first? Because low credit risk, high transparency, clear yield curve pricing, institutional familiarity. Short-duration treasuries have minimal duration risk. In a 4.5% Fed environment, short-term yields remain attractive. Institutions prefer starting tokenization with low-risk assets, not volatile equities. Treasuries are the bridge between TradFi and crypto rails. $1,000 growth model, institutional context. Let's assume tokenized treasury yield 4.7%, compounded annually, minimal fees, $1,000, $1,047 in 1 year. Not exciting, but scale matters. $10 million? Now that's $470,000 annually in programmable yield. And here's the key difference. Those tokenized treasuries can be used as collateral inside blockchain-based lending systems. Traditional treasuries cannot be rehypothecated that way without intermediaries. This increases capital efficiency. Capital efficiency is everything in tight liquidity cycles. The real advantage, it's not yield, it's programmability. Treasuries become instant collateral, on-chain liquidity, tradable globally, settled instantly. Wall Street doesn't care about crypto culture. It cares about cost reduction and efficiency. And tokenized treasuries reduce settlement risk, counterparty friction, operational overhead, That's why institutional adoption is accelerating. The bridge. But treasuries are just the starting point. They're safe, predictable, institutionally digestible. The real growth opportunity? Private credit, infrastructure debt, yield streams traditionally locked behind million-dollar minimums. And that's where the shift becomes exponential. Where the real money is moving. We started with tokenized treasuries. Safe, predictable, institutional training wheels. Now, we move into the assets that actually move the needle. Pillar 2, tokenized private credit, yield with structure. Private credit is one of the fastest-growing asset classes in the world. Over the past decade, it expanded from a niche strategy to a multi-trillion-dollar market. Why? Because banks pulled back after 2008, and someone had to lend. Private funds stepped in. Now, add tokenization to that. Instead of a $250,000 minimum investment into a private credit fund, you can fractionalize exposure on-chain. Projects like Apollo Global Management, private credit giant, BlackRock expanding tokenized liquidity products, Ondo Finance bridging treasuries and structured yield on-chain. The model is simple. Off-chain borrower, structured credit agreement, tokenized representation, yield stream digitally, advanced metrics, why institutions care. Private credit typically offers 8 to 12% yields in higher rate environments, floating rate structures, senior secured positioning, key metrics, debt to EBITDA ratios, loan to value LTV, default rate history, free cash flow coverage. When tokenized, the asset itself doesn't change, but access does. The blockchain layer reduces administrative overhead, settlement friction, distribution barriers, and that increases total addressable market. $1,000 growth model, private credit exposure. Assume 9% annual yield, reinvested annually. 5-year horizon, $1,000 $1, 538. Compare that to 4.5% treasury yield, $1,000 $1, 246. That's nearly $300 difference on a small allocation. Scale that to institutional capital and the numbers become massive. But higher yield always means higher risk, which leads to the next layer. Pillar 3, tokenized infrastructure and real estate cash flow assets. Global infrastructure demand is exploding. Energy transition, grid modernization, transportation upgrades, data centers. Governments don't have unlimited capital, so private capital fills the gap. Infrastructure assets typically generate predictable cash flows, inflation-linked revenue, long-term contracts, traditionally access required, private equity funds, long lockup periods, large capital commitments. Tokenization changes distribution. Now fractional exposure becomes possible. Projects like tokenized, commercial real estate, solar farms, logistics hubs are emerging on blockchain networks. Advanced metrics, what actually matters. For infrastructure assets, internal rate of return, IRR, net operating income, NOI, debt to equity ratio, cash flow stability. In higher rate regimes, assets with strong free cash flow outperform speculative growth. That's why infrastructure and real-world yield assets are attractive in 2026. Stable 6 to 10% cash flow with inflation linkage beats chasing volatility. $1,000 growth model, infrastructure case. Assume 7% annual return, reinvested over 10 years. $1,000 $1, 967. Not flashy, but steady, and when combined with liquidity and fractional access, it becomes scalable. This is where retail investors start gaining access to structures once reserved for institutions. But here's the twist. The biggest upside might not be the asset. It might be the protocol layer facilitating it. Pillar 4, the infrastructure layer, the picks and shovels. In every gold rush, the shovel sellers often win. Tokenization requires custody infrastructure, compliance frameworks, smart contract platforms, institutional-grade blockchain networks, Major ecosystems enabling RWA expansion include Ethereum, Polygon, Avalanche. Why? Because institutions demand high throughput, low settlement cost, regulatory compatibility, asset token standards. As more real-world assets move on-chain, transaction volume increases, network utilization increases, and in many blockchain models, increased usage can correlate with higher token demand. Advanced metrics to watch for protocol evaluation, total value lock (TVL), network transaction growth, fee revenue, developer activity, institutional partnerships. This is the equity layer of the tokenization thesis. Higher risk, higher volatility, potentially higher upside. $1,000 growth model, protocol exposure. Assume 12% compounded growth over 8 years. $1,000 $2 476. But volatility could be 30 to 50% drawdowns in downturns. This is not savings account safe. This is growth capital. The bridge. So we now have 4 layers: tokenized treasuries stability, private credit yield, infrastructure, and real estate cash flow. Protocol layer, growth leverage, but none of this matters without risk control. Because tokenization doesn't eliminate default risk, regulatory shifts, liquidity freezes, smart contract vulnerabilities, and 2026 will not be a zero volatility environment. Risk, margin of safety, and the 2026 reality check. We've built the thesis. Now we stress test it, because tokenization is infrastructure, and infrastructure only matters if it survives pressure. Risk management, defining the margin of safety. First rule: tokenization does not remove asset risk. It only changes settlement mechanics. If a private credit borrower defaults, the blockchain doesn't save you. If a real estate project underperforms, the token wrapper doesn't fix cash flow. So, what's the margin of safety in a tokenized RWA portfolio? 1. Tiered allocation structure. Think in layers. Tier 1, stability, 30 to 50%. Tokenized short-duration treasuries. Tier 2, yield, 20 to 40%. Private credit or infrastructure exposure. Tier 3, growth, 10 to 30%. Protocol layer tokens. The exact mix depends on risk tolerance, but concentration risk is how people get wiped out. 2. Underwrite the asset, not the token. Before buying any RWA exposure, ask, what is the borrower's debt-to-equity ratio? What's the loan-to-value? Is yield fixed or floating? Who is the custodian? Is there regulatory oversight? If you can't answer those questions, you're speculating, not investing. 3. Liquidity assumptions. Here's the uncomfortable truth. Many RWAs trade in thin markets. 24/7 availability does not equal deep liquidity. Liquidity is like oxygen. You don't notice it until it's gone. During a liquidity crunch, spreads widen, and tokenized assets can decouple from NAV. That's a real risk. Black swan scenarios. What breaks the thesis? 1. Regulatory shock. If U.S. regulators classify certain tokenized assets as unregistered securities, liquidity could freeze, capital could retreat, adoption slows. 2. Major default event. If a high-profile tokenized private credit fund defaults, confidence drops, capital exits rapidly. Remember, 2008 wasn't about housing alone. It was about trust. 3. Smart contract failure. Code risk is real. Exploit, bug, Oracle failure. Traditional finance has operational risk. DeFi has smart contract risk. Different plumbing. Same fragility under stress. 4. Rapid rate cuts. If the Fed cuts rates aggressively below 3%, Treasury yields compress. Private credit spreads narrow. Yield advantage declines. The RWA narrative loses some urgency. 2026 macro outlook. Why this pivot continues. Despite risks, structural forces support growth. Sovereign debt remains high. Infrastructure funding gaps persist. Capital efficiency matters in higher rate regimes. Institutions want faster settlement. The key driver isn't retail speculation. It's institutional cost reduction. If tokenization reduces settlement from T+2 to near instant, that frees capital, and freed capital generates return. That's not hype. That's balance sheet math. The three non-obvious takeaways. 1. This is not a crypto story. It's a capital markets modernization story. Blockchain is just a rail. The asset still matters more than the token. 2. The yield is not the edge, access is. Institutions already had access to private credit and infrastructure. Retail did not. Tokenization democratizes minimum thresholds. That's the unlock. 3. The real asymmetry is infrastructure. If tokenization scales toward hundreds of billions, the networks and compliance layers enabling it may experience exponential demand growth. But they carry higher volatility. Stability and upside sit in different buckets. Exact action plan. If you're evaluating this theme, Step 1, decide your role. Are you seeking yield or growth leverage? Step 2, start with asset-backed exposure. Don't jump straight into protocol speculation. Step 3, limit any single RWA exposure to a small percentage of portfolio capital. Step 4, monitor regulatory developments, institutional adoption metrics, default rates in private credit markets, on-chain TVL growth. Treat it like a sector allocation, not a lottery ticket. If you want a breakdown of how to structure a 2026 RWA allocation across stability, yield, and growth layers, check the 2026 Portfolio Framework linked below. It outlines allocation models, risk tier structures, metrics to track quarterly, scenario stress tests, because the goal isn't to chase trends. It's to position before structural shifts mature. Final question. Here's the real question. Will tokenized assets become the new financial plumbing, or will they remain a niche experiment layered on top of traditional finance? Is this the modernization of capital markets, or just another crypto cycle narrative? Drop your take below, because if Wall Street is building on-chain rails quietly, the smartest investors won't ignore it. They'll study it early,